leading indicators have declined 14 months in a row. Now, I remember in the day when this measure of leading indicators was down for 3 consecutive months, the conclusion most economists would draw is that the economy is going into a recession. Well, now we're 14 months into it. And we do believe we'll see a recession, a little bit of a harder landing, as I've mentioned on many of these. M2 down 5% on a year-over-year basis. Haven't seen that since the 1930s. And we do think velocity is starting to slow down. The velocity of money, the rate at which money turns over, because of the regional bank crisis and the concerns. Wait, what's going on here?
The geopolitical landscape of global finance may soon experience a seismic shift as Brics, a prominent economic coalition comprising Brazil, Russia, India, China, and South Africa, contemplates a potential common currency. The murmurings in the corridors of economic diplomacy revolve around a seemingly audacious idea, yet the group's final decision on the matter remains undecided. Current developments suggest that the Brics nations are moving toward de-dollarization, reducing their reliance on the US dollar. But rather than converging towards a shared currency, these countries are gradually leaning toward transactions in their national currencies. While a sweeping change like a common currency could alter the dynamics of international trade, such a transition may be farther on the horizon than recent speculation suggests. The New Development Bank, NDB, an entity established by the Brics bloc, recently quelled rumors of an immediate push toward a common currency. Cathie Wood shares the various economic indicators that are signaling this shift in the global economic landscape. She also talks about the market signals and how Bitcoin is a hedge against inflation. Let us now join the video and listen to Cathie Wood.
I wanted to feature some of the stronger than expected before we go into weaker than expected. Housing and autos, interestingly, delivered some surprisingly strong statistics. We see pending home sales down 21% on a year-over-year basis. That sounds very weak, and it is. But one of the reasons is people are trapped in their existing homes by their current mortgage rates, which are very low compared to today's. And so we're seeing new home sales is where a lot of action is taking place. New home sales were up 12% month to month in the month of May, I believe that was. And housing starts were up to 1.6 million from 1.34 the previous month. That's an annualized number. So the new home sales are where a lot of the action seems to be going these days. Autos came in a little higher than we expected. Last month was 15 million units at an annual rate. This month was 15.68 million units at an annual rate. What we see going on in the auto sector, this dramatic shift towards electric vehicles, we believe is starting to put pressure on the auto manufacturers. They've reintroduced discounts. Remember, they were selling at premiums before. Reintroduced discounts. And we think they're trying to move their inventory as this consumer preference shift towards electric gathers momentum. So that could be one reason for this. The other variable that was on the stronger side was durable goods orders. Non-defense capital goods orders, ex-aircraft, is a very good indication of capital spending, and we do think two things are going on there. One is the excitement around artificial intelligence has captured consumers and businesses' imaginations, but there's also an imperative here. If your competition embraces this new technology, which can help you increase productivity and decrease costs, you're going to be in trouble. So a little bit of a land rush there. And also there is the reshoring especially from China, taking place here in the United States. So those are two of those reasons. And those are strong. But back to the leading indicators. The leading indicators are made up of 12 sub-indicators. So they are average workweek claims, new orders for manufacturing, ISM new orders, building permits, the S&P 500, the credit index, the yield curve, and consumer expectations as measured by the Conference Board. Now, those have all been negative for 15 months. And as I mentioned, if we don't head into recession, meaning declining activity, it will be quite a big setback for this measure of leading indicators, and may suggest that it is too much focused on the industrial world and not enough focused on the digital world. That could be the case. Nonetheless, they are negative, and a lot of the regression analyses that I see from economists are pointing towards negative GDP sometime in the second half of this year and into, and some are saying through, 2024. This will get the Fed to change its spots. And the market, which had taken such a serious tumble last year, had seen this, we believe, and has discounted a lot of this. Maybe not all. There are some investors I know, moving back into more value-oriented strategies, which are more hostage to the cycle, figuring, we're going to skip a recession. I don't think that's going to be the case. I think that companies that are comfortable, have secular growth opportunities, that are recession resistant, they won't escape a recession entirely, but recession resistant, that they will continue to be rewarded.
This year has had some big surprises, of course. 6 months ago, we expected an extension of 2022 where inventory would keep rising due to ultra-slow demand. But demand stabilized and new supply was even more rare, which led to declining inventory and home prices holding up. Mortgage rates seem to be climbing again, though, and consumers are sensitive to the affordability challenges that creates. What will it take for inventory of homes to build for the second half of the year? If mortgage rates climb, demand will slow and inventory will build up like it did in September and October of last year. If mortgage rates stay under 7% or ease lower, homebuyer demand will increase, available inventory will shrink, and home prices will have even more support than we've already seen in 2023. This is important to pay attention to because conventional wisdom right now suggests that a return to lower mortgage rates will bring new inventory. But the data tells us that lower mortgage rates decrease inventory. What does Cathie Wood think about the market signals? Let us find out in the video as we watch.
There are investors out there who do not religiously depend on the broad-based indices, but are doing their homework and are saying and asking the question, who is really going to benefit from this massive shift towards artificial intelligence, which is gaining so much momentum because AI training costs are dropping 70% per year. And they're coming up with good answers, we would say. This is what we do all the time, and it's nice to have the company again, if I might say. Long-term interest rates, they moved up from 364 today, 405. Interesting, we're getting a good test here. In March, the 10-year Treasury bond yield peaked around 4.8 to 410. Today it's 405. In October before that, it had a peak at 4.3. So lower highs, we are having a little bit of a test here. And we'd be surprised to see long rates continue to move out because of the weakness that we see evolving in the economy, and because inflation's coming down, and because it could be negative, which I think would shock a lot of people. I was around, did a roadshow in Europe last week, and I asked the question, how many of you here are hearing forecasters talk about deflation? Nobody. Maybe one hand went up, and I said, I think you heard us talking about that. So no one's talking about it, and our confidence is increasing that it will happen, that it won't be all bad. Innovation is deflationary. I just told you AI training costs are dropping 70% per year. That's going to seep into many, many other costs and cause unit growth to accelerate. The Bloomberg Commodity Price Index, it moved up 3% in the month of June, but is still in a downtrend. Should have mentioned the yield curve is still inverted. It got more inverted last month. It got to almost 110 basis points, which is the inversion it reached right before the regional bank crisis. It's come off that a bit here, but we wouldn't be surprised to see if it signaling, more crises, whether they're in the commercial real estate market or in the private equity market in a way that we don't understand right now. Bitcoin, sort of the harbinger for crypto, up 10%, good month. And of course, there is the speculation about a potential approval of a Bitcoin ETF. That got people excited. But the other thing we'd like to reiterate is we saw Bitcoin take off from 19,000 to 30,000 when the regional bank crisis was in full force in March, April. And that told us that Bitcoin is a flight to safety currency. It's a hedge against inflation. It's a hedge against deflation. Deflation presents counterparty risks that do not exist in the world of Bitcoin. And we think innovation broadly is going to become a flight to safety category.
Even as Bitcoin holds around $30,000 and other crypto assets seem to be trading in cautiously optimistic ranges, the real change is still on the horizon. In late June, there were multiple applications filed with the Securities and Exchange Commission to launch spot Bitcoin exchange-traded funds. This is not the big news in and of itself. With similar applications having been filed and rejected previously, the real difference is which institutions have submitted these applications. These include some of the largest financial firms in the world, with BlackRock and Fidelity serving as the headliners of this current crop of applications. The market need for more comprehensive crypto trading solutions is simultaneously obvious to most market participants and difficult to achieve following the litany of failures in the sector. The world's largest crypto exchange, Binance, continues to face significant headwinds when seeking to establish new offices across the globe. Even Coinbase, the only U.S. publicly traded crypto exchange, is facing lawsuits from the SEC. The path forward does not seem to be driven by the crypto-native sector. Rather, as evidenced by both these recent ETF applications and continued investment in tokenized asset applications, TradeFi is seemingly coming around to the market appetite and opportunities to be found in crypto assets. Speculation aside, there are several concrete ways that a spot Bitcoin ETF will change crypto trading. The first and most obvious way that spot ETF products will change the marketplace, especially those supported by firms such as BlackRock, is that this will cause downward pressure on trading fees and commissions. As a direct result of lower fees and trading commissions, it is almost a given that more automation and potentially AI-based trading will be coming to the crypto sector sooner rather than later. The former president of FTX US, Brett Harrison, has founded a new crypto exchange that will be infused with AI to facilitate trading, market making, and other operations. A reality that is set to irritate members of the Bitcoin maximalist community is that the submission and approval of a Bitcoin ETF and the inflows of capital that will follow as portfolio managers and asset managers rebalance accordingly will further diminish the likelihood of Bitcoin being used as a currency. As the appeal of Bitcoin as an asset class continues to move into the mainstream and be leveraged by individuals and institutions alike, forecasting higher prices, entrepreneurs and other businesses are less likely to take and make payments in this token. What do you think of the various signals and indicators shared by Cathie Wood? Let us know in the comments section below. Also, don't forget to give us a like, subscribe, and turn on notifications. Thanks for watching.